topic that I had outlined for today, which is what deductions can real estate investors expect? So let's start off with the first deduction. The first deduction I like to talk about is interest expense deduction. So what is interest expense deduction? You're allowed to deduct the interest that you pay on the loan that you use to secure the property. So let's say that you paid $5,000 in interest expense for the year. You are allowed to take that $5,000 and deduct it from the rental income that was derived from that property. The second deduction is property taxes. Now, property taxes also can be directly deducted from the rental income that's produced by the property. The third deduction is property insurance. Now I know you folks are used to not being able to deduct your property insurance because that's against your primary residence. But because you own an investment property, property insurance is now deductible from your rental income. It's a good thing. The fourth deduction is repairs and maintenance. So if you do any repairs and maintenance to your investment property, you can deduct those repairs and maintenance right from the rental income that's derived from that property. But keep in mind, if the repairs and maintenance are such that they're large in nature, they may have to be classified as capital expenditures and depreciated. Which brings me to my fifth and favorite topic, the deduction for depreciation. Now, what is depreciation? What is a depreciation deduction? A depreciation deduction allows you to deduct a portion of the cost of the investment property that you purchased. Let's do an example. Let's say that you purchased a $300,000 property. Now, I want to keep in mind that there's two components of the purchase price. The first component is land, which is not depreciable by code. The second part is building. The building part of the purchase price is depreciable. So let's take that example of the $300,000 property and break it into two components. Let's say $100,000 is land, $200,000 is the building. So the $200,000 for the building, you can take a depreciation deduction for. But let's further define the assumptions. Let's assume that this rental property that you purchased is residential rental property. Residential rental property is depreciated over 27 and a half years. Taking into consideration our example, the $200,000 property is going to give you a $7,270 deduction off of the rental income of the property that you purchased. It's pretty powerful. But what's most powerful about depreciation, it's a non-cash expense. And what I mean by that is, it's not like where you write a check for, say, property insurance or write a check for repairs and maintenance. This is a non-cash deduction. So therefore, there's no cash coming out of your pocket. It's one of my, as I mentioned, it's one of my favorite deductions. Now, properly structured, all of these deductions can significantly reduce your W-2 income. So that's all I have for you today. Thank you for joining me, and I wish you much success in your real estate journey.